in listen-only mode.
Hello and welcome to today's market update for June 2015 for the Investor Signals Premium account. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals. I have 17 years of experience in the financial services industry and a licensed securities advisor. The format for today's presentation, we do a quick summary of the macro events driving equities. We look at the XJO and the ASX Top 50 with a view around earnings and dividend yields, along with technical trend forecasts. We combine that with a portfolio allocation for our premium account portfolios and conclude with a short-term market outlook. The Investor Signals Premium account is based on a model portfolio of ASX Top 50 stocks. We utilise call options to enhance portfolio returns. We're focused around effective ownership around ex-dividend dates, trying to generate above average cash flow from dividends and call premium while still delivering some capital growth. It's all invested under a strict investment mandate, which is suitable for self-managed super funds. And most importantly, the assets remain in your name and you have the final say. If you'd like to know more about Investor Signals and the premium account service, please contact me, leon@investorsignals.com, or on the Sydney number on screen there. Moving straight into a graph of the XJO. Now, we've seen the Australian equity markets correct over the course of the last few weeks, really driven by a result of continued weakness in the resources and maybe somewhat unexpected ongoing weakness in the banking sector. At an international level, first quarter 2015 US reporting results continue to show a reasonably positive trend, with earnings per share growth for the S&P 500 running at around 3%. Now, that's down on where it was if we go back, say, 6 to 9 months ago, but really that's prior to when the energy names collapsed. So as a broad average for S&P 500 stocks in the US are delivering around 8 to 10% growth. Now that's come down to 3%. But a big part of that fall off is the negative impact of the energy names. If we strip out those energy names in the S&P 500, US earnings are actually still maintaining a pretty healthy level at around that 8 to 10% year-on-year growth. In our domestic market, which we're now looking at a chart on screen of the XJO, we've seen our market pull back to a level where yields are now pushing back up to around 4.5–5%. And as we roll through the top 50 stocks, I'll identify the companies within the top 50 that we think are starting to deliver good value, and we're adding those back into the portfolio. So you can see the green circle on there. I'm of the view that the index is likely to find support and put in a higher low here. And I think that's largely driven by a gradual improvement in Japan, gradual improvement in Europe, stability in the US, and what hopefully through an improving Europe starts to become slightly better data out of Asia as well. So I think although there's some risk to equities that we could have a 10% correction, that's really predicated off the back of, probably ongoing disruption in Europe and possibly, continued weaker data out of the US, but that's certainly not our base case. I think we'd probably like to see an improving data backdrop in the US over the next 3 to 6 months. I suspect for our market, we'll put in a low here at around 54–5500, and I would expect to see the earnings results in July, August generally surprise to the upside, and I think what we're looking at is a buying opportunity ahead of those numbers. So on that note, let's go into the top 50 stocks and let's just start rolling through them, and I'll provide some quick commentary. AGL, the point of note here with AGL is the company's just come out and indicated that they're going to be divesting certain assets, implementing a fairly aggressive cost-cutting program, and increasing, as a result of those measures, their dividend payout over the next few years. And that's really what's caused AGL to jump from this sort of $15 level up to around $16 odd dollars. We were owners of this at lower levels, and it's been a stock that we hold in pretty much all client portfolios, albeit last week we started taking profit on AGL, and really on the basis that I just don't see that there's a lot more upside. The good news is priced in. I think now investors have to wait to see whether AGL achieves better than anticipated prices for the assets that they divest, and investors have to wait for the increased distributions from the dividends to come through. I think we're in for a period of probably 6 to 9 months of consolidation. With 1550 now becoming the new support and probably 1650 becoming resistance. So it's not to say we won't buy back into AGL towards the latter part of this year, but I think we're likely to see a consolidation, and really 1550 is about the range that I think AGL should be trading at, which puts it on a roughly around 4.5% dividend yield. Asiano trading at about 4% dividend yield on 2016 earnings. That's allowing for about 10% earnings growth. I think that could be a little bit optimistic. I'm really not interested in Asiano unless it pulls back to around $6. Amcor trades on about a 4% forward dividend yield into 2016. The yellow box on screen there just indicates that I think it's really likely to trade within a support of around $13.50, resistance at around $15. I think it's got to consolidate and trade sideways for a good 6 to 9 months before we start to get another leg higher in Amcor. It's a name that we continue to own in portfolios, but need to be selling covered calls against it to justify sort of this grind sideways that we're anticipating. A combination of the dividend and the call premium delivers about 10% cash flow. So it's a name that we continue to hold in portfolios and see the downside risks as pretty limited. Now, AMP was a bit of a disappointment in last week's trading. It was down roughly around 7%. We've avoided AMP in client portfolios, but maybe at around $5.50, $6, it starts to become interesting, just simply on the view that it's broken out. It's coming back, likely to put in a higher low formation somewhere at around this 585. I have AMP delivering about 5% earnings growth over the next 12 months. It's on a 5% dividend yield, but I've spoken a lot about it in the past in that the earnings have been patchy. There's still some uncertainty, albeit the picture obviously has been a lot better over the last 18 months than it had been for quite some time. But relative to other areas of the market, we find more certain opportunities than AMP. ANZ, so the first half 15 results missed consensus by a smidgen, but more it was the outlook commentary from the Australian banks that have scared investors, combined with the fact that there's some concern around the property market. Is it overheating? Is there a need to sort of reduce the speed in which mortgage growth has been occurring, those type of things? But really it's been predominantly driven by the commentary starting out of CBA that there's going to be limited earnings growth, if any, over the next 12 months. So what we've seen is the banking stocks really fall from a compressed yield of 5%, now coming back down to around 6% dividend yield where they sit at the moment. I think the assumption should be that they deliver flat earnings over the next 12 months, and on that basis, on roughly a 6 to 6.5% yield, you would think that they're starting to come into a period where they represent okay value again. ANZ should deliver a dividend of around just under $2, about $1.90 a share over the next 12 months. So at around sort of this $30 level, happy to start to take another look at it. But ANZ is certainly not our preferred bank. Here in APA, I'm just going to shift this forward and say, probably somewhere around this $8.50 level might be worth keeping an eye on this one to see if it creates a high low formation. The ASX, about 5% earnings growth over the next 12 months, about $1.95 of dividends to pay out, puts a stock at about just under a 5% dividend yield. We've been owners of this one at lower levels. We've taken profit, and I've been waiting for it to pull back to around this $39.50 level here before we start becoming a buyer of it again. And I think we're just starting to sort of see it pull back into an area that's worth taking an interest in. And I'd put that one on the high conviction list as we roll through these top 50 companies. Horizon, this is one of the ones that I had identified over the past months as a preferred investment opportunity. The stocks remain strong off the back of good cost control, ongoing restructure of the workplace agreements, and reasonable haulage numbers. The stock delivers about 31 cents of earnings per share over the next 12 months. They'll be paying out about 22 cents of that in dividends. It puts the stock on about a 4.5% dividend yield. At around $5.50, I've maintained its pretty full value, and this really is a solid addition to portfolios. But if we're buying in at these levels, a little like Amcor, needs to be selling the covered calls, a combination of the call option and the dividend, driving around 10% cash flow. But I don't see a lot of downside risk there in Horizon. BHP, I'd highlighted the negative structure developing here in BHP, and we're seeing some what I think are probably relatively short-term weakness. Given the view on the index is that it finds support at roughly 5,500, it is likely that that coincides with some support in BHP as well. So looking for it, maybe it dips down to low 27s, but looking for it to actually find support and stabilise at or near these levels. BHP trades on these on current forecast numbers. It's now pushing back up to maybe something in the order of 5.5–6% dividend yield. Brambles likely to come in at the lower end of the earnings guidance, which puts the stock on about a 3.5% dividend yield, paying out about 38 cents in dividends over the next 12 months. And this is another one of those ones that I've spoken about where we really like Brambles, but I've reiterated now for the last few months that $11.50 the stock's expensive. Maybe at around sort of $10.50 it's okay value. Certainly at $10.20 it starts to get really attractive. But really, when I say it's attractive from a valuation stand, to put that in context, as I said, even allowing for around 10% earnings growth, which is probably a little bit above what the company's likely to deliver, the stock's only going to be on a 3.5% dividend yield. So even if we saw a pullback to say $10, $10.20, maybe we see that forward yield push up to about 4%. I'm very comfortable adding it into client portfolios at or near that sort of low $10 to $10.50 level. I think it's obviously a beneficiary of the lower Aussie dollar, and there's still on a relative basis, a company that's delivering 5 to 10% earnings growth still looks attractive, I think. CBA. So we initially started to look at this at around sort of this $85 to $88 mark, but never ended up allocating capital. We've just started buying into CBA now at the end of last week. I think sort of as the case with BHP, if you take an index view, if the market's likely to find support at around 5,500, one would have to think that CBA's starting to come down to a level where it should attract some buying interest. On a yield basis, it's now pushing back up to around 5.6, 5.7% dividend yield, which is, I think, sort of ultimately where they'll find support and track sideways. Coca-Cola, at around $11, I said it was expensive. At around $9.75, $9.50, I think it's okay value, allowing for just flat earnings over the next 12 months. The stock's on about a 4.75% dividend yield. I think that should start to generate some buying support. It'll be a higher low structure, which we haven't seen for a while in Coca-Cola, in that it's broken out. It's now pulled back. As long as we ultimately see volume and buying interest start to build, I think we could get a structural higher low here and hopefully a push back up above $10 in Coca-Cola. Computer shares on a reasonably low yield, about 3%. The company should deliver maybe something in the order of 5% earnings growth. The story here, like a number of these companies with offshore earnings, is obviously if the Aussie dollar falls, Computer Share gets the benefit of the currency conversion. I like Computershare, but I don't see a lot of opportunity for it to trade too much higher. And I think increasingly as we hold Computershare, and we've been waiting for a rally up to 1350 before we sell the covered calls, I'm probably more inclined to think that at around this sort of 1250, it's just simply worth going up to 1350, selling calls out to December and starting to generate the extra cash flow out of Computershare. CSL, so the healthcare sector's well and truly outperformed financials over the last week or so. When you look at CSL, the stock trades about 2% dividend yield, should deliver around 10% earnings growth. It's still one of the star performers, albeit it is a little bit expensive to the extent that we own it, selling covered calls over it and trying to complement the income out of it. Caltech, so this one comes onto the list for the first time from a commentary perspective within the top 50 index. I think interesting that we're just starting to see some of these buy indicators come in. So at around this $30 to $32, it certainly comes on the radar, and I'll comment more on Caltex in next month's recording. Crown Resorts, in last month's recording, I'd made the point that around this sort of $13 level, the stock was likely to find some support. There's still risks to earnings. We're seeing downward revisions in Macau, but from a valuation perspective, Crown now trades on about a 3.5% dividend yield, about 14 times forward earnings, and we're looking for about 8% earnings growth over 2016. I think the stock bounces from here, maybe rallies up to around $14. Don't see it doing too much more than that. Dexus, the whole property sector is pulling back during the course of last week. Dexus is not our preferred allocation. I'll skip through that and stop on the property stocks that we are adding to portfolios at present. Goodman Group, so we generally don't chase Goodman Group. It's not a stock that we can sell covered calls over. The company should deliver about 8% earnings growth, pay out around 24 cents of dividends per share. We really would only develop a strong interest in Goodman Group. There's no doubt it's one of the star performers in the property sector, and it's likely to continue to be. But given where the yield sits on it, and even on forward 2016 numbers, I've got it tracking at, lucky to be on a 4% dividend yield. So I think it's expensive by any measure. At around $5.50, I'd be keen to take a look at it. That probably puts it back on about a 5% dividend yield, which I think is the absolute sort of bare minimum to be expressing an interest in Goodman Group at. GPT, so it's pulling back a little bit at present as well. It's on a little over 5% dividend yield, but I think somewhere around this 420 to 440 should be a buy on the dip opportunity for GPT. IAG trades on about a 6% dividend yield, paying out roughly around the same as last year, maybe around 33, 34 cents of dividends per share. Looking for the stock to find support and trend higher from where it is at present. IPL, it's had a great run. We've taken profit on IPL. I think it tracks sideways between $3.60 and $4 on a pullback to $3.50, $3.60. Keen to take another look at it. James Hardie delivered a good solid earnings number. Surprise market with a special dividend. I think you're likely to see the stock hold up at these levels, and obviously the building data in the US continues to remain strong. I've got James Hardie trading on roughly a 4% dividend yield, and likely to deliver something close to 20% earnings growth over the next 12 months. So on a relative basis, again, a name that's really delivering above average earnings and probably justifies a far closer consideration for portfolios. So that one certainly comes onto the radar. Lendlease, still within this property development construction space. We like Lendlease. It has been a little expensive, and we've been sellers of it up at around this $16.50, $17 level. But any pullback down here to around $15.50, we're buyers of it again. Puts the stock on about a 4% dividend yield, looking for about 10% earnings growth out of Lendlease. Deserves to be in portfolios. Mirvac, interesting, comes onto the radar at around $1.80. These property names have been hit and that feeds into a little bit of this view around the concerns of the Australian banking sector as well. But generally, I think the backdrop for the global economy still continues to remain relatively supportive, and probably a buy on the dip mentality still needs to be applied within equities at the moment. We're just trying to be very selective as to which ones we dip our toe back into the water as the market goes through this sell-off that we're experiencing at the moment. Again, keep that in context that the index is getting pretty close to where I think it's likely to find support. But in the case of Mirvac, trading at around 5.5% dividend yield, but not one we're adding into portfolios yet. Medibank Private, I want to own this name coming into the earnings result in August. I don't think it'll be as bad as the market's fearing. I've got the stock now creeping back up to about a 4% dividend yield. I think it's a buy down here at sort of this $2, $2.10 range. Macquarie Group, little cautious there. Preference is to actually chase the value in the domestic banks. NAB, I got the stock now pushing up to about 6.5% dividend yield. I think it'll be a buy on the dip. Maybe it gets down to $30, but ultimately this, I'm sure, we'll look back in sort of 3 to 6 months and see it as a short-term buying opportunity, not suggesting it has the short-term momentum to take out this high, but I think we're likely to find support somewhere between sort of this $32 and $30 range, and I'd expect the stock to rally back up to about 34. So we continue to sort of keep an eye on this and look to allocate money gradually into what we expect to be sort of a buying opportunity over the weeks ahead. Newcrest, looking for this to now have another rally and trade up to around $17. I think there's still upward momentum in gold price from the recent lows at sort of 1,100-1,200 an ounce. Origin, not doing too much here. I've spoken about the long-term prospects for Origin being positive. However, over the next 12 months, I think the stock trades sideways at around this $12.50 to $13. In most cases, we had, after owning at lower levels, we'd taken profit here of around $13.50. Maybe from a $12 to $12.50, it starts to become interesting to add back into portfolios again. Oil Search, not doing there at present. QBE, this is one of those ones again that's breaking out to the upside. The company's strengthened its balance sheet, delivering slightly increasing insurance margins after a number of years of seeing those margins contract, supported by the lower Aussie dollar, and obviously if we do get bond or yields in the US creeping up, that'll help QBE. I think it sort of had its rally, looking for a pullback, maybe back down to $13. I've put this higher low flag here in a question mark, just because I'm not sure that it'll actually pull back that far, but maybe it's a consolidation and then a move higher. But there seems to be upward momentum and increasing interest in QBE by large fund managers at present. Ramsay Healthcare, great stock, very solid earnings, something in the order of 20 to 25% earnings growth. However, trading on a very expensive multiple, 30 times last year's earnings, 25 times forward earnings. For us, that's just been a little bit too expensive. If we do see any sort of weakness in the market and it throws up a buying opportunity for Ramsay, maybe at around $55, very keen to take a look at it. Rio, as with BHP, under pressure, same sort of technical pattern, lower lows, lower highs. There's a little bit of speculation there that Glencore's continuing to sniff around assets of Rio, potential mergers. From a valuation standpoint, I got Rio delivering about 5.5% dividend yield, and again, tie that in with the view on the index. If the index finds support at around 5,500, one would think BHP and Rio are actually going to find some support here. South32, which is the spin-off from BHP, been a little bit of a volatile start. Came on to the board at around 215, traded up to 250, now down to 214. I'll continue to sort of review the data on South32. There's speculation that the company, will be very disciplined around cost control and cost cutting, may look to return capital to shareholders. From what I can see, they appear to be committing to paying out about 80% of earnings in dividends, and over the coming months we'll continue to cover South32. For clients that hold BHP and have received a small allotment in South 32, it just needs to be weighed up. If owning the stock's not really going to shift the needle too much one way or the other in regards to the performance of the asset, I think there's a justification to cut it. For clients that are holding a larger parcel of South 32, I'm probably inclined to say wait 12 months and then have a look at sort of where the stock settles. In the case of SCG, the stock trades now on a dividend yield of around 5.5%. And my view here really hasn't changed. It sort of around this sort of 360, 370, the stock's okay value. Don't see earnings growth much above sort of maybe 3% maximum. So one would think that it's sitting sort of in that sweet spot for property trusts that don't have earnings growth when you consider it against, say, Goodman Group that's going to deliver 8% earnings growth. It's on a 4% dividend yield. You look at, say, Scentre Group that's unlikely to deliver any growth, maybe 3% at the most. Sort of then you see those names sitting in that fair range of around sort of 5 to 5.5%. So I don't think there's probably too many surprises with Scentre Group, but from a yield perspective should track sideways. Should be reasonably defensive. Owning the stock, selling a very tight covered call over it, delivers around 10% cash flow. So that's the way we tend to look at sort of some of these property trusts where we're not getting a whole lot in the way of earnings growth. SEEK will be interesting to have a look at SEEK earnings results. We'll probably just continue to keep this one on the radar until we get through the July-August earnings season. From a forward basis, the company should deliver about 20% earnings growth, and we'll continue to sort of monitor that and get a better feel for whether we want to be adding SEEK into client portfolios. Stocklands, I think this sell-off that we're seeing at the moment for the first time brings Stocklands back onto the radar. Now, we had owned Stocklands over the last few years, and we most recently have taken profit at higher levels. It's only now sort of that's back down to around $4 that it might be interesting to start taking a look at it again. From a yield perspective, the stock's trading back up at around 5.5% yield. The company should deliver about 5 to 8% earnings growth. I think this sort of dip where we're looking at the moment will probably be a reasonable buying opportunity, and it's worth adding Stocklands back into portfolios, I think, in the week ahead. Sonic Healthcare, a little bit too expensive for me. We owned it at lower levels. We sold the covered calls. We delivered the stock. We effectively got $19.50 for Sonic as a combination of the sale price at $19 and the 50 cents for the call option. Sonic probably will deliver a number that I think will disappoint the market in August, and for that reason I just remain cautious on it. Unless we saw a pullback to sub $19, I wouldn't be in too much of a hurry to jump back into Sonic. Again, either waiting till August until the earnings result comes out, or really only participating if we have a period of sort of more significant market weakness. I have Sonic trading on about a 4% dividend yield, but yeah, a real question mark over forward earnings. Santos, not doing there at present. Suncorp really tracking sideways, I think on about a 6.5% dividend yield. Not expecting much in the way of earnings growth over 2016 for Suncorp. Maybe they deliver a dividend earnings per share of around $1.08 and maybe pay out somewhere around 92, 93 cents of dividends per share. Still the possibility of special dividends, albeit with the insurance claims that we've seen. We're probably likely to see Suncorp just retain a little bit extra capital. So, maybe we're still in line for another special dividend, but maybe not two over the next 12 months like the market was originally expecting. Sydney Airport's not doing there at present. The stock's pulled back to around a 4.5% dividend yield. If we saw it back a little bit further at around sort of a 5.5% yield, I think that'd be a good buying opportunity. Similar with Transurban, it's pulled back to around about a 4% dividend yield on current numbers and about a 4.4% dividend yield on forward numbers. Should pay out about 44 cents of earnings per share. So that's allowing for roughly around almost a 10% distribution increase from this year to next year. So we're already pricing in a reasonable amount of growth there, and it still only puts it on a 4.4% dividend yield. So I spoke about this one in last recording, saying fair value really is sort of $10 max. I think it's one of those situations where sort of $9.50 is a buy, $10 is fair value. If you can sell the covered call up at $10.50 and get 10% cash flow from that dividend and the call premium, I think we're likely to see a period where Transurban just moves sideways. But a reasonable argument that it deserves to be in portfolios as long as that covered call strategy is in place. Telstra. So Telstra's fallen away a little bit off the back of sort of consolidation in the telecommunications sector and just concerns around competitive pricing offers that are coming into the market. But I think once the result comes out in August, I suspect the market's concerns will somewhat be dismissed. So I'd see this as a buying opportunity for clients that don't already hold Telstra. It's worth adding it into the portfolio somewhere between, say, $5.75 and $6. I think coming into the August dividend, it starts to trend higher. From a yield perspective, Telstra's now on a forward basis of about 5.4%, and that's assuming their dividends kick from 30 cents, which they were this year, up to 32 cents next year. I think that's in line with company forecasts. Westpac, now trading about just over a 6% dividend yield. I think if we strip out the prospect of any earnings growth over the next 12 months, assume the company pays out about $1.90 of in dividends per share, I think that starts to sort of put a base under where these banking stocks are at present. Again, that feeds into the view around the index. So happy to start sort of nibbling at adding Westpac back in the client accounts. Wesfarmers, the company should deliver about 8 to 10% earnings growth over the next 12 months. That'll mean the company should deliver earnings of around $2.40 per share, roughly $2.20 of dividends, puts it on about a 5 and a bit % dividend yield. Should find support here. I think it's one of those high conviction buy on the dips over the next week. So any opportunity to add Wesfarmers into portfolios at around this sort of, say, $41 to $42 level, I think should be well rewarded. And I think probably a little bit of patience will need to be used here, because I don't see the equity market doing a whole lot until we probably get through the next, say, 8 weeks. Ultimately, I think the Australian earnings results will be reasonably positive and support the yield story in some of these names. Westfield at this price, allowing for about 5% earnings growth, the stock's on a 4% dividend yield. It's a buy at around this sort of $9 level. I think it's worth accumulating. Any rally up to $9.50, sell the covered calls, turn the 4% yield into 10% cash flow. Woolworths, roughly trading about a 5.5% dividend yield down here. Really, the market's assuming not only no earnings growth, but starting to probably price in the prospect of some slightly negative earnings over the next 12 months, maybe something in the order of 2 to 3%. I suspect until Woolworths is clearer on the cost-cutting strategy and is able to appease the market's concerns with some better data out of their master's hardware strategy, I don't think it's going to be a quick turnaround for Woolworths. I think for clients where we're holding Woolworths in portfolios, it's really about being comfortable just collecting the dividend yield of around 4.5–5%. And I think you're probably sitting on sort of a 12 to 24 month recovery period here in Woolworths. Maybe the stock can trade back up to $30, at which time you could sell a covered call, collect a little bit of extra income, turn that 4%, 5% dividend into 10%, and try to sort of ride up that recovery where the calls are not getting exercised, and then the strike price can be ratcheted up. But for clients that have new money coming into the market and are not already exposed, I certainly don't think it's an overweight position, Woolworths, but still owning Woolworths, Wesfarmers, some exposure into the Australian banks on this sell-off, a focus around names like Brambles, Amcor, Computershare, Westfield. I think they all sort of complement sort of the rounding off of the asset allocation in client portfolios in this present market. Woodside Petroleum, I don't see this name doing anything short term. From a yield perspective, it trades on about a 5.5% dividend yield, really just tracking sideways. Don't see too much in the way of earnings growth. And selling a covered call up at around $37 and owning the stock at these levels, again, delivers about 10% cash flow, and I don't see a lot in the way of downside risk there to Woodside. And then finally back to the index. So a quick summary of where we're at. I think the market's probably likely to run into some buying support. The global macro picture doesn't look to be deteriorating, albeit growth data out of the US over the last couple of quarters has been reasonably weak, but at a company level, as I mentioned at the beginning of the recording, stripping out energy names, S&P 500 companies still are delivering about 8 to 10% earnings growth. I think the Australian market's got a little bit jittery over the last few weeks. Once the earnings results come through in July, August, I expect the market to probably begin to rally ahead of that as people realise that the defensive yield names are still likely to deliver okay growth. And from a portfolio allocation, as I discussed, I think Woolworths, Wesfarmers, a little bit of mix in the banking stocks at present, owning those offshore US dollar earners, CSL, Brambles, Amcor, Computershare, Westfield, using the covered call strategy to enhance portfolio returns. I still think being exposed to equities makes sense in that environment. And if you'd like to know more about the Investor Signals service and how we can work in partnership with you to help manage your portfolio, please either email me, leon@investorsignals.com, or call 02 9238 8188.